We're here today to talk about a fascinating new chapter of the Global Financial Stability Report, which deals with some of the risks that are associated with the rapid growth and the enormous size of open-ended investment funds. Here to talk about it, I'm joined by Fabio, Natalucci, and Felix, Suntheim, the authors of the chapter. Welcome, both of you. Thanks for being here.
Thank you so much.
Fabio, let me start with you. Give me an overview of what you discovered. What do we know about this asset class? How has it grown?
Yeah, so this asset class has grown a lot, right? So since 2008, we have seen almost like a fourfold increase in the asset under management. They are up to more than 40 trillion now globally, and they account for about 1/5 of the overall non-bank financial sector assets. So it's clearly very fast growth. They play an important role in the financial sector. They play both in terms of credit intermediation, right? They provide credit essentially as non-bank lenders to the corporate sector, for example. Some of them operate in the mortgage market. So it's an important channel of credit intermediation. They provide liquidity services as well. So they play a fundamental role in the financial system. They also have vulnerabilities. So some of them have to do with, but that's what the focus of the chapter is, liquidity mismatch, right? Between the liquidity that they offer to investors, in this case daily, and the liquidity of the underlying asset, whether these are treasury securities, clearly are more liquid, or corporate bonds, or you go into the more illiquid real estate. That is one of the vulnerabilities that the chapter is focused on. This has been one vulnerability that played a role during the financial crisis, and we have seen once again, during the March 2020, during the COVID, where this vulnerability effectively becomes an amplifier, right? If there are fire sales, you amplify the price moves, it becomes essentially amplify the shock. The reason why we're concerned here is because we are in the policy normalization cycle. We start seeing tightening of financial conditions. We have seen rates moving higher. So there is a concern that this tightening of financial conditions may interact and be amplified by some of these vulnerabilities. I think that's the macro framing of why we focus on this sector.
Felix, explain to me mechanically how the vulnerabilities that Fabio's identified actually translate into actual forms of stress that we ought to be concerned about.
Yeah, so as Fabio said, what we're doing, we look at these open-end funds that offer this daily liquidity to their investors, but that may hold relatively illiquid assets.
Can you give me an example of these sorts of funds?
Corporate bond funds, for example.
Mutual
right?
funds, yes.
Mutual funds. So investors can redeem on a daily basis, but for the fund, it may take much longer to actually liquidate assets to then meet these redemption requests, right? And that creates this liquidity mismatch that Fabio mentioned. And this can lead to incentives for investors to actually redeem ahead of others, right? Because the investor who redeems first is not subject to the transaction costs that the fund has to bear in the subsequent days, right? And that's the key vulnerability that we have in mind here and that we look at. So we try to measure how exposed funds are to this illiquidity. So how illiquid are their portfolios? That's our measure of liquidity mismatch. And then we check whether assets that are held by funds that are relatively illiquid, whether these assets are more fragile. And with fragile, we mean here whether these assets, their returns, whether they are more volatile. Right? And that's indeed what we find. So especially for assets that are inherently less liquid, like corporate bonds, for example, we find that a decrease in the liquidity of the funds that hold these assets, that leads to an increase in the volatility of the asset, right? And that's the channel we have in mind here. So less liquid asset holdings by funds can lead to more fragile securities markets.
So if I understand correctly, what you're saying is that even if a member of the public is not an investor in these funds, they're in some sense subject to the risks those funds create because they may transact in these bonds whose own volatility is being increased by the behavior of these funds. Am I right?
Yeah, by the behavior of these funds and by the behavior of the investors in these funds, right? That's correct.
So you mentioned March 2020. All right. So explain to me what happened then, because that in some sense was a trial run of the kinds of risks that you're talking about, right?
So the concern there is that some of these vulnerabilities had been identified already after the financial crisis in 2007, 2008. But some of it had not been addressed. So I think 2020 essentially brought to the fore again some of these vulnerabilities. So we have seen very large asset price declines in that period during COVID. And some of this decline asset prices actually filter through this asset, the behavior investor that Felix mentioned, so trying to get to the front of the door before the other investor can do that. And that behavior exacerbated the price move. And that declines in asset price, essentially, whether this is equities, corporate bonds, or other less liquid asset, was amplified by the behavior of the investor and essentially by the liquidity mismatch between the daily liquidity and the underlying asset. Obviously, that dynamics stopped once central banks stepped in. We have seen massive intervention by the Federal Reserve in the US and other central banks in advanced economies. And that boosted market sentiment, and you've seen like a V-shaped recovery in asset prices. But the question is, this is essentially the second time in 10 years or so that we have seen central banks having to step in to backstop the financial system. So I think that's a question like, do we need to address this vulnerability so that we don't have this recurring episode where this vulnerability gets essentially unmasked by a shock?
Could you describe for me a little bit for the people watching, what does this market look like? I think the figure said it was $40 trillion, is that right? So what types of assets are we talking about? Like, what does that $40 trillion consist of? What nationalities? And who are the funds and so forth? Just paint a picture of this market for me.
So the open-end fund market it's a global market, of course, but the majority of funds are domiciled in advanced economies, a big part of them in the US. They, of course, hold assets globally, both advanced and emerging market assets.
Are they primarily fixed income, cash?
In our analysis, we look at funds that hold bonds, sovereign bonds, corporate bonds, high yield and investment grade, and equities mostly.
Within these classifications, are there certain asset classes, certain geographies that are more vulnerable than others? More a source of concern than others?
So yeah, clearly what we find is that those assets that one would call inherently less liquid, so say high yield bonds, corporate bonds, emerging market bonds, these assets are also those which tend to be more vulnerable because they are held by funds which are less liquid in general.
What does this mean for the real economy? So if you have these stress periods, like one might say, well, if the investor is aware that the asset they own is volatile and might be subject to things, as long as they know about that, that's fine. That's how the market works. But are there in fact risks to the real economy from these vulnerabilities? Is there a scenario under which you can see credit intermediation itself affected?
I mean, this was in some sense the rationale for the Federal Reserve to step in, right? They were trying to maintain the flow of credit to households and firms. Part of it flows through the traditional commercial banking balance sheet, right? Those are the traditional loans and mortgages. Part of it is essentially finance, if we're going to use this word, through this sector, the investment fund sector. These funds hold corporate bonds, they hold loans, bank loans sometimes, they can hold mortgages, and that's another way to financing the real economy. So to the extent that these funds do not continue to provide credit, that the credit intermediation function essentially is hampered, that would have implication for the real economy because there will be less credit going to household, less credit going to credit, to business. And that's, I think, the story, in fact, that the central banks were telling. We want to maintain, this is the reason to step in, is to maintain the flow of credit to the real economy.
Governments too, are there scenarios where, for example, an emerging market economy, or maybe an advanced economy that has a very large external deficit might actually be locked out of markets because of these risks? So
the emerging market, actually, it's an important point to make because there are not only an advanced economies issue, but there are important cross-border implications, right? So there was an FSB report, which I had the privilege to co-chair. We looked exactly at this. We looked at how vulnerabilities in emerging markets. So think of as FX, for example, mismatches between assets and liabilities. Think of liquidity mismatch. How those have interacted with mutual fund, essentially open-end of investment fund that actually invest in emerging markets. So when COVID came, the shock came, asset price dropped. This investor ran for the door out of these countries, and those shocks were exacerbated and interacted with some of the underlying vulnerabilities. So those are important implications also for emerging markets, particularly because some of these funds are not just emerging market dedicated, right? So their mandate is just to invest in emerging market, but they're more broad global funds. They are passive funds, they benchmark an index, so they're much more sensitive to global financial conditions. So when global financial conditions tighten, these funds tend to essentially withdraw. And so these cross-border linkages related to the structure of this fund, I think that's another important angle to keep in mind in terms of vulnerabilities.
It's interesting to hear us talking about the risks to credit intermediation and access to markets for an emerging market in the context of inability to access the capital markets, because you've been around for a long time and doing this for a long time, and we thought that the lesson of the Latin America debt crisis and like the Asia financial crisis, that we need to get away from the bank-based system. The capital market system is a more like continuous system. And also, the lesson of the global financial crisis was the enormous risks posed by systemically important depositories and bank holding companies. And so, as you know, we spend an enormous amount of time in this country, in the United States, and other countries internationally, reinforcing capital and liquidity standards, stress tests for the core regulated parts of the financial system. But in some sense, did a failure to apply that same level of scrutiny to the non-bank sector bring us to the situation we are here today with asset management vehicles?
So I think 2 points. One, just to clarify, there are benefits from emerging markets being able to access global capital markets, right? And investment fund is one way to do that, because you diversify the investor base, right? It's not that just local investors are your investor base, but you can actually access global capital markets. So there are benefits in terms of like growth from global finance. I think the issue is that they could become, though, an amplifier of underlying vulnerabilities. That's the point I was trying to make. More broadly, I think the post-global financial crisis, what the international regulatory reform was about strengthening the core of the system, right? So increasing the quantity and quality of capital, liquidity of banks. Banks are at the center of the system. The clearing houses, and so centrally cleared. All that was about making the center of the system stronger. Obviously, risk doesn't go away. So I think one unintended consequence of that was that risk migrated away from the center to what I like to call the periphery of the system. Now, there is nothing wrong with that. If you think about this risk diversification, there could be other investors with different risk profile, risk appetite, different funding structure. And so it's OK that the risk move. The question is, one, can we see where risk is? Can we actually monitor when risk moves to the periphery of the system? Second one, do we have the tools to address? Right? If we think that there are vulnerabilities building outside the traditional core of the system, do we have the tools to do this? Right? In this case, macroprudential policy tools. Do we have a way to intervene? And if the answer is no, then I think the next step becomes at least to consider where the perimeter, the regulatory perimeter should be. If central banks every 10 years or so at this point need to step in and backstop the entire financial system.
Yeah, no, that's a good point. So let's talk about today now. We've talked about the risks that we learned from the March 2020 events. When you look out at the markets that you've been studying today, do you see any vulnerabilities, any signs of stress, anything that we should be keeping an eye on?
Right. So when we look at asset markets today, and specifically the portfolios of the funds that hold these assets, we see that liquidity has deteriorated quite substantially in 2022.
And by what, can you just describe what you mean by that, liquidity?
Liquidity basically is the ease at which funds can sell the assets. We measure that in our analysis with the bid-ask spread, but there are other ways of getting to that. So we've seen that liquidity deteriorated, and that of course means that the vulnerability of these funds, so that liquidity mismatch that they are facing, that has increased. And we've also seen outflows from funds throughout the year, together with normalizing of monetary policy. So we've seen outflows from emerging market funds, from bond funds. So all of that sort of points towards heightened vulnerability and heightened risk.
So, of course, the event that everybody is talking about now is like a few days ago, markets were roiled by events in the United Kingdom, a perceived clash between fiscal and monetary policy, and there are very large movements in bond markets. Fabio, what did we learn from this event, and does this seem to show some of the risks that you've been talking about in this chapter?
So clearly we are in a different macro environment, right? So at least those of us who have been around for a while, high inflation was never a concern, if you want. But we are in a different macro environment. Inflation is high, it's stubbornly high. It may take a while to bring it down. And so it's really important that central banks act with resolve to bring inflation down credibly to target. That's crucial for their credibility and their independence, I think. And so they need to act. The issue here is that creates some challenging trade-off of choices for central banks. So they need to address inflation. Of course, there is a growth implication to that. And then there is also the financial stability issue, right? So if the tightening of financial conditions, which is an intended objective of policy, this is if you want to slow down aggregate demand, that's essentially a consequence of tightening of monetary policy. But that tightening could interact with some of the vulnerabilities that we have been discussed. I think in the case you have mentioned, there were concerns about the rapid increase in UK yields and the depreciation of the pound, and how may affect the position that some specific financial institutions had in place. And the Bank of England felt to achieve their financial stability mandate that it was proper to step in and take measures that would actually address some specific financial stability risk. And they've done in a very targeted and timely manner. They make clear there is a window over which they will conduct some of these operations, and then they will unwind in an orderly way and continue to tighten monetary policy to address inflationary pressure. But it is a good example what kind of challenging environment central bank face as they need to hike rates to address inflation, consider the implication for growth, and then avoid financial stability events. An additional point, I think that's why it matters for everyone, though, not just for the UK policymaker and financial system, because we have seen global rates moving together across the globe in the last few weeks or days. So we have seen not only when the UK rates were moving higher, but also US rates and European rates moving higher. And then post Bank of England intervention, we have seen a decline in rates, not just in the UK, but also in the US, for example. And not just the long end, so not just long duration yields, which perhaps had to do with hedging position or flight to quality flows, but also on the front end of the curve. That part of should be much more influenced by monetary policy in the US than financial stability episode in the UK. So this is just to make the point that this affects everyone, and so this is why it's crucial to address.
So just to break this down a little bit, so when we see British long-dated gilt yields go up, and that ricochets when we see short-dated US Treasury yields go up, that doesn't really make sense from a purely economic point of view. It seems to reflect something in the underlying dynamics. Is that revelatory in terms of like the high degree of risk and leverage out there, and that the participants in these markets, the asset managers, the liability managers, are in some sense moving between markets in ways that essentially amplify, propagate shocks?
I mean, this is hard to tell, obviously, unless you are in the regulatory world and you have actual data. But there could be a number of factors, right? One of them could be how you manage the portfolio, for example, right? Especially if you want to manage duration risk with either derivatives or taking position in different markets. Two, also what kind of portfolio you have. If you have exposure to, say, foreign asset, for example, maybe that's one way to manage the portfolio. There are also factors related to flight to quality flows. We have seen very sharp decline in asset prices, and so people could actually flight to quality toward the liquidity and safety of US Treasuries. So there are a number of factors involved here. I think the point I was trying to make, though, is this is not just very specific jurisdiction financial stability event. When things happen, they have implication, I think, for the broader global financial system, and that's why they're important to tackle.
So that brings us, I think, to a very important question, which is what should policymakers do about this? I mean, given all the factors that you've identified in your report, Felix, what are some concrete measures policymakers can take to mitigate these risks?
Right. So clearly what's important is for funds to use liquidity management tools, right, to manage these outflows and the liquidity risk they hold on their
Could you tell me what you mean by liquidity management tool?
Right. So for example, one way for a fund to deal with the outflows and that these and passing on the transaction costs from liquidating assets to the redeeming investors, one way to do that is to use price-based measures such as swing pricing and anti-dilution levies. So it's basically just a way of taking the costs that funds have to incur because of the transactions and passing them on to the investors. And that reduces or eliminates investors' incentive to run on a fund or to exit ahead of others. Right?
Can you give me an example of how swing pricing works?
So swing pricing, basically, the way that works is the fund at the end of the trading day looks at whether it received inflows or outflows. If the fund receives substantial outflows, it would adjust the price, its net asset value, it would adjust it down, right? That is the swing down. And that would mean that the investors redeeming on that day receive a lower price, and that protects the investors that to remain in the fund from the dilution from these exits of the fund, right? And that basically eliminates the incentive of investors to redeem ahead of others, and it doesn't create these excessive redemptions that we would otherwise see. So one recommendation we have in our chapter is to use these price-based tools more effectively and more widespread. So currently what we see is that funds often have caps on how much they can swing. So even if markets are relatively volatile, if markets are relatively illiquid, they would not use a swing factor, they would not move the price down by enough. One recommendation would be to eliminate these caps, and for regulators and supervisors to monitor more closely on how these tools are implemented.
So I recall that after the financial crisis over a decade ago, there were similar concerns raised by money market funds and the fact that they maintain a constant asset value of $1, and perhaps that had encouraged people to treat them as more liquid than they really were. And there were moves, I think, after that in the United States to require them to actually, in some circumstances, provide a more real-time changing estimate. What did we learn from that? Does that show us that the mechanisms you're talking about can help mitigate those risks?
Yes, I think it's a very similar idea, right? Having a constant NAV basically means that price is fixed over even longer time period, right? Whereas here, for these open-end funds that we are thinking about, it's the price at the end of the day, not reflecting the transaction costs over the next 2, 3, 4, or 5 days, maybe, right? But again, it means basically getting away from that stale price at the end of the day and making it more flexible.
Can I add one point on this? So this is obviously, we look at a menu or policy option, right? So this is one price-based measure. I think we are also aware that in some jurisdiction, because of the institutional setup, legal constraints, or operational issues, that swing price may be less easy to adapt. So we also provide and look at other possible options. For example, one of them being linking more closely the liquidity of the underlying instruments in the fund or investment with the kind of liquidity that gets provided to the investor. So to the extent that there is a very large liquidity mismatch, perhaps daily liquidity for some very liquid investment, like real estate, for example, that is maybe not the proper way to do if swing prices are not an option. And so linking more directly the frequency of redemption with the liquidity of the underlying asset, that would be another option.
So for example, instead of being able to sell on any given day, you must wait a week or a month.
Right. So you need to provide, give advance notice, and then you can always withdraw, say, once a week, once a month, so that it's another way to deal from a quantity base, if you want, as opposed to the price base.
Is there, some of these asset managers are very large. They have trillion-dollar balance sheets. Is there a case that some of these asset managers should be treated as systemically important institutions the way we already treat the very largest banks?
So I think one important issue is those are very different from banks, right? Banks have a balance sheet, there is a asset, liabilities, equities. In case of investment funds, some of these assets are owned by the investor themselves, right? So those are not asset owner the way you call an insurance company or pension funds. So they essentially have a mandate on behalf of the investor. So I think that part, it's an important consideration and one need to have in mind when you think about this. The other way to do is to address the specific vulnerabilities, right? Whether this is liquidity mismatch, for example, whether they use leverage. Leverage is another good example. I think we have, at this point, despite many years since the financial crisis, it would be great to have a much better visibility and data on the leverage usage of some of these funds. Sometimes it's very hard to actually get the data. So leverage is another amplifier, right? Not just a liquidity mismatch. So one can look, instead of looking at the entity from a systemic perspective, you could also look at the various vulnerabilities and so try to tackle some of this. To me, leverage is the one that I think we should be able to do a much better job in terms of monitoring that kind of vulnerability.
Given all the regulatory changes that were made after the global financial crisis, does it look to you like the appropriate mechanisms and authorities exist to do what you're talking about, or are we still looking at significant gaps between, the instruments out there that pose risks and our ability to regulate them?
So the Financial Stability Board has a number of work streams in place looking exactly at what they call the NBFI, so non-bank financial institution vulnerabilities. So they've identified some vulnerabilities. This is how systemic those are. And they're working to produce a number of reports. To me, the main issue remains three. One is visibility. Right? We should be able to actually have visibility into this corner of the financial system. Sometimes we don't. Investment fund is an example. You can think of private debt. Private debt is another example where there's very poor visibility in terms of risk and exposure. The second one has to do with data. To be able to have visibility, you need data. And in some cases, for some sectors, like, the data are very, very poor. So collecting, everyone should agree on having better and more available data. And then the last one, the tools. Do we have the right tools? And I think there some more work needs to be done. And we need to develop tools to be able to actually hit all the possible corners of the financial system.
Could a case be made that these institutions, the private sector themselves, should adopt these practices that you've described, or is that asking too much?
Clearly, at the moment, funds do use these tools. So it's not that none of these funds would employ liquidity risk management tools. They do that. I think there's a question of whether these tools are calibrated appropriately, whether funds have the right incentives to set these liquidity risk management tools at the right level, right? And that's probably the point where regulators or supervisors might have to come in to make sure that the calibration is done correctly. So it's not that these tools are not available. It's I think their implementation and the correct calibration of these tools.
Yeah.
Yeah, an important point is also, again, that these are not just jurisdiction-specific issues, right? There are cross-border implications on some of these vulnerabilities, and the emerging markets is a good example. So this is why you want to look at a global financial stability perspective to this.
I want to finish with one last question, which I realized I didn't touch on earlier, but I think it's important. Is the fact that we are at a moment when central banks are tightening interest rates, does your work suggest that that is a time of especially high vulnerability?
So we do see in our analysis that monetary policy uncertainty is an amplifier. So these vulnerabilities from open-end funds and the effect they have on asset prices, that this mechanism is particularly severe when monetary policy uncertainty is high. And yeah, so we might clearly be in a situation where that is the case.
Well, this is a fascinating topic. Thank you very much for taking us through your work on this. Really important. I'm sure we'll be hearing much more about it in coming weeks.
Thank you so much.
Thank you.